Polystat Rhythm Biosciences. Hello, my name is Dean. Today we'll be evaluating Polystat project by Rhythm Biosciences. I would like to introduce my fellow team members, An, Gina, Intan, and Irfatan. We provide some general information about the project and the company, alongside financial statistic and calculation relating to the two alternatives. Let's start with Polystat. A breakthrough in colorectal cancer detections. This method stands out for its impressive accuracy with 95% detection rate. It offers swift turnaround time, delivering reliable results within 7 days. This quick and accurate detection is crucial for early intervention and treatment. Next, we have alternative A, known as Project Nucleosomic Bioevolution RX. This project focuses on isolating circulating nucleosome from blood sample by detecting epigenic changes in nucleosome from the earliest stages of cancer. Finally, alternative B is Project Cures CRC by Colorectal Cancer Alliance. This project working on developing vaccine to prevent the recurrence of colorectal cancer. It leveraged AI by utilizing existing large datasets and creating new ones to advance precision medicine. Move to this financial status of Rhythm Biosciences. Debt ratio around 0.23, meaning it isn't heavily reliant on borrowing. This implies the company could potentially acquire additional debt for future growth. Additionally, current ratios of approximately 4.03 show that the company is well positioned financially in short term with a strong liquidity to cover any immediate liabilities. A total assessed turnover ratios of 0.4 suggests that the company might be facing challenges in effectively using its asset to generate sales. Return on equity approximately 0.56 is an indication of strong financial performance, suggesting that the company is highly efficient at converting its equity invested by shareholder into net income. Earning per share is approximately 6.3, suggests that the company's shares are relatively low to its earning, which could indicate undervaluations.
Evolution RX is a clinical diagnostic company. It's based out of Nevada, USA, and is developing Project Nu-Q. It is a easy-to-use blood test kit, and it has a wide range of applications such as veterinary and cancer, etc. Moving on to the assumptions. So for 2023, the O&M cost sits at around $56 million. This has witnessed a major increase in the R&D sector from 2022, from $50 million to $18 million alone. The expected price per kit is $150 USD, and with a maximum manufacturing capacity of 4 to 4.5 million kits annually, we're expecting the revenue to be $96 million. We're also applying an inflation of 5% annually. This brings us to the cash flow statement. So for year one, with a revenue of $100 million and being absorbed 60% by the O&M cost, we're left with a taxable income of around $33 million. And we're also applying an income tax of 30%, which leaves us with a net income of $23 million. We see a dramatic increase due to inflation in year 20, giving us a net income of $63 million. So there are two main risks I would like to talk about for this project. First one is the technical risk. So achieving high accuracy in cancer detection is critical for their success. Ensuring accuracy requires overcoming several challenges, and in order to achieve optimal balance between sensitivity as well as specificity, Evolution RX needs iterative optimization of their assay parameters, including cutoff thresholds and more. Second risk is regarding FDA approval risk. So obtaining approvals from these type of agencies are a very time-consuming process, and delays in this process can impact the project timeline. The company can seek assistance from product development consultancy firms with ISO certifications to carry out their development as well as paperwork.
Okay, next, alternative B, the Project Cure CRC by the Colorectal Cancer Alliance that was based in Washington, D.C. and founded in 1999. This project aims to reduce colorectal cancer, which is the second leading cause of cancer death worldwide, and to improve patients' outcomes. The objective for this project are to assess, evaluate, and to ensure adequate funding for the operational and investment activities, mainly to generate a positive cash flow. After several years, the inflation rate, which is 5%, also taken into account, as this will both affect revenues and expenses over the project's operational life. Proceed to the cost and benefit of this project. Next. The capital cost is almost 13 million, covering all the project establishment, including the assets. The operating cost is around 2 million, and the maintenance cost for 4 million, covering the annual maintenance and personnel costs. The revenue projection is 11.5 million annually from various sources and program services. Next. Next is the table for alternative cash flow statement with inflation rate. So the net income is 12 million for the first year and 39 million for the year 25. As you can see, there is a huge gap between the values there. Next. Next is the qualitative risk assessment. Our primary focus is on identifying and managing non-quantifiable risks that could significantly influence the project's financial health and overall success. Firstly, is to identify the key qualitative risks. The high likelihood is the funding shortfall, with the likelihood and impact high and the detection difficulty is low. Next.
All right, so the viability indicators that we've decided to use are payback period, net present value, benefit to cost ratio, and equivalent annual cost. It's especially important to note that we've included equivalent annual cost, as it's particularly useful when projects have different project lives like ours. So in interpreting the results of alternative A, it'll take around 1.33 years to recover from the initial costs. The net present value is approximately $337 million, which is positive and indicated that the project is profitable and viable. The benefit to cost ratio has been calculated to be 10.68, another positive result which further indicates a viable project. And lastly, the EAC calculation highlights that there will be an annual cost of approximately $62 million for the operation and maintenance over the project's lifetime.
For alternative B, the PP is calculated to be 1.47 years. This indicates that we will cover our initial investment from the net cash flows within the first year and a half after the investment is made. Next, the NPV for alternative BA is approximately around $43 million. This positive NPV indicates a significant net gain in present value over the project's life. Moving on to the BCR, which stands at 11. A BCR greater than 1 indicates a highly profitable project, and a BCR of 11 clearly marks this as a very favorable investment. And the last one, we have EAC, which is around $500,000. This figure represents the average annual cost of that, considering the total cost of ownership, operation, and maintenance over its lifespan converted into an annual expense. Next.
Okay, so the quantitative risk assessment determined the effect that different variables have on the net present value. So for alternative A, it was determined that the revenue and manufacturing costs had the strongest influence, where if revenue decreased by more than 25% and manufacturing costs increased by more than 45%, there'll be a negative net present value and the project would no longer be deemed viable. So in terms of the approximate variable rankings from the highest critical value to the lowest, as you can see in the critical value table just there, the revenue is around 80% critical value, the manufacturing costs has around 47%, followed by discount rate with 13% and initial costs with around 1.8%.
For alternative B, our project's NPV is very sensitive to changes in the value. A critical value percentage change of 35.3% means even small changes in revenue can significantly affect our NPV. Next, discount rate. This is the second most important variable with a percentage changes of 27.27%. Changes in the discount rate also have a big impact on the NPV. Next, for initial costs, it have a moderate influence on the NPV with a percentage change of 8.12%. And the last one, manufacturing and O&M cost, this variable is the least sensitive with a percentage change of only 0.28%. Last but not least, the recommendation for further analysis. So the first one is the market segmentation, which is to tailor intervention and enhance targeting. The long-term outcomes monitoring to track progress and refine strategies. The stakeholder engagement analysis to ensure community involvement and support. And the patient journey mapping to improve patients' care and satisfaction. To ensure our analysis is robust and reliable, we need to address potential weakness, which is the data limitation, assumption risk, scope limitation, lack of stakeholder input and the complexity. The regular review and refinement of the analysis process are crucial to continuously improve its accuracy and reliability. By addressing these potential weaknesses, we can enhance the quality and effectiveness of our analysis, leading to a better informed decisions and more successful project outcomes. That's all from us. Thank you for listening.